All right, what's up? What's up? Good morning, everyone. Good early morning. It is so early, but here I am reporting the Nebius earnings for quarter four of 2025. All right, it is bright, or as Wolf Ryan would say, it is dark and early, and the markets are looking pretty good this morning. I mean, to be honest, I don't know if I trust this move right now in the market, but I will take it. I will definitely take it. I even like someone commented last night, and they were saying, "Oh, please let Nebius save us, and please give us a God candle, right?" And then I thought to myself, look, if I see a God candle, I am not going to trust that candle. We saw the same thing with IREN. We saw the same thing with many stocks this quarter. This quarter has been extremely brutal for a lot of companies in the market, and it'll be nice if it's up, but I mean, we've held through worse, right? We've held through a lot worse. So bring it. Okay, so what is the Nebius trading at this morning in the pre-market before the earnings? Okay, we're up a little bit. That's good news. They didn't already report, right? Did I wake my ass up late? I think I might have woke up late. Please tell me they didn't report and I just missed that entire thing. Let's see here. No, they did not report. They did not report yet. I like posts like this. It's funny. Oh wait, no, that says I'm holding Nebius like my future depends on it. I thought he said, please let Nebius pump like my future holds on it. So let's see over here. But well, okay. So, anyways, wow, wakey, dude. I am so tired right now. Like it's not even funny. My eyes are just burning right now. I thought I was gonna be on this, and my eyes would be red, but hey, we are doing good. Oh, whoa. What is going on, Midwest? How are you, sir? Business Fishy, how are you? Ticker Tap, how you doing? Yeah. Oh wow, you were like messaging me last night. Not messaging me, but you're like posting on some of my stuff last night at like 12 midnight my time. Either you're located across the world or you are just ready to hustle and bustle this morning. What is going on? How are you? Oh, yeah, there you go. Yeah, so we're just saying hi over here. Guys, I can't even think straight. It is so early right now. Whatever is this early, like I got nothing but energy and it is great, but I can't even think right now. I am so tired. If this thing is red, I'm going to turn off the stream and just go to bed. Like it will not be worth it. If Nebius is down 10%, I'm just going to turn off the stream and going to bed. Like there's going to be no point in staying awake. Hey, but if we're up 10%, all right, I'll take it for now. Let's see if it sticks. We've seen this rodeo before, but I'll still take it though. I'll still take it. All right, so TSM is up 1.5%. TSM is over here trading at all-time highs in the middle of the night. We have basically the data center stocks kind of up a little bit, but like I don't know, 1.5%, 2.5%. That's like one tick on Nebius. It's not. I got to see it stick. I got to see the real beans. All right. Show me the money. 650 in Bangkok. Very good. Thank you, Thailand. All right. Ryan Invest. How are you, sir? I need it lower so I can buy more. Wouldn't you love that? I would love that too, but I would need a lot lower in order to keep that in this position. But I need a lot lower, man. I need a lot lower. EU, Germany. Yes. Welcome. I don't know how to say hello in German, but anyways, guys, all right, let's check out the earnings hub over here. Let's see what numbers we're looking at for Nebius Q4 earnings. And then I'll go over some of my solid thoughts in a minute. All right, so we have Nebius. You know, this is actually pretty interesting on Earnings Hub. I remember that they did not even have Nebius listed here. Now it's like the #1 stock listed here. So that's always good to see. All right, so we are looking at 238 million estimated for the quarter and minus 54 cents, of course, and that's even the adjusted or non-GAAP. But that's expected. We're not coming into this quarter expecting any sort of profitability or anything crazy. The last time Nebius reported, they were down 7% after earnings, and they were down 1.2% before earnings. Nebius closed yesterday at 3.5%. So times 3, that means Nebius is going to be down 21% after. Just kidding around, guys. I don't know. Call me. What's called? Call it PTSD. But this has not been a great quarter for earnings whatsoever. Like this quarter for this earnings completely has just been brutal. Like you would think that some companies do like really good, but let's just say thankfully Nebius is not a software stock. Yeah, all right, too soon. I'm sorry, but like that would really suck. If it was a software stock, this would definitely be in the gutters. But all right, so what are we looking for? All right, so let me just bring up the last quarter. Let me bring up the last quarter slides, and I'll tell you a few things that I'm looking for in this one. Honestly, my expectations for this quarter are not high. I'm not coming into this quarter thinking like, oh, we better get a big deal announced or something like that, or oh, we better get like more than $7 to $9 billion ARR or anything like that. Like they are guiding for an annualized run rate at the end of 2026 for $7 to $9 billion. And one thing you guys got to remember is that there's two things. One, this is for the end of 2026, okay? 7 to 9 billion ARR. And two, you got to remember how they calculate ARR here. It's an annualized run rate. They take the last month reported on the earnings and they multiply it by 12. That's how they get the annualized run rate. So if we get $7 to $9 billion ARR, oops, I'm just whipping out my calculator. I'm not sharing the right tab, am I? I'm on this screen. My bad. All right. So if we have, okay, I got my calculator open. Let me just share the entire window so you can see what I'm doing over here. And all right, okay. All right. So if we got 7, 1, 2, 3, 1, 2, 3, 1, 2, 3, that's your $7 billion in the low end of the range. We divide that by 12. We need the last quarter of fiscal year 2026, which I believe they are. Yeah, their fiscal years are the same as calendar years. So a year from now, we need them to say to get the $7 billion that their last month in that quarter was $583 million at least. Okay. The last quarter in Q3 2025, they came in at, I saw the number on Earnings Hub. Hold on. That was their, yeah. So the last quarter, it was 32 million, right? So the last month of last quarter was 32 million. And then their ARR, so you got the 32 times 12, the ARR was $384 million. All right. So actually, no, that was 3 months ended. Wrong time. 146. I don't think that's how they calculate that one. 146 million. And did they say how much they got in September over here? Yeah, they don't say it exactly. But I don't see it there. Anyways, last quarter was $146 million. So we're probably expecting, let's see here. It grew last quarter at 333%. It's very likely that, let me bring up the fiscal AI. All right. They're thinking 238 million. Fiscal AI says that the quarter a year ago came in so $37.9 million. And then if we do if we do 333% year, let's just say 302. Last quarter, they came in at 355% year-over-year growth. If we're coming in somewhere around 355% growth, so then we're going to have to multiply this by 4.35, 164 million. And then the estimates for this is what I do in real time, guys, just to see what the estimates are as far as the revenue growth. This quarter, they are coming in with estimated $242 million. So if they're expected to have $242 million, that means they need to re-accelerate. $158 million last quarter. 242.79. All right, so we got 58. Interesting. Why does it say 58? Let me go back there. Okay, so it's $37.9 million, but it says 58. So then 34, let's just say 35, and the Wall Street estimates for this company are at 244. So then that means we need, I think that's what it was, right? No, it's going to be more than that. Okay, so they're supposed to reaccelerate growth to like 600%, I believe. So 35 times 8. Okay, so 700%. So somewhere from 6 to 700% revenue growth is expected this quarter. That is actually pretty in line with what I had modeled out. I mean, the thing is that I don't expect this to be, like I mentioned before, I don't expect this to be a quarter where it's like we're totally surprised with the numbers that they put out, right? So, because mind you, they are guiding for $79 billion annualized run rate at the end of the year. So this quarter does not have to be like a complete beggar, because if I were to take 280 million and then the way that they accelerate, I would say 120 of this is actually for the last month, right? So 120 times 12, that would put them at $1.44 billion annualized run rate. So that's how they're calculating it in these earnings. I don't expect this number to probably be this high. I think maybe like 1.2, $1.3 billion, but like, I gotta be honest, like, it doesn't matter exactly what the number is. I think the street is going to do whatever they can with it. What's going to matter, one, is the commentary. Two, are any deals that they do announce in their earnings, which for me, like, it's expected they're going to get more deals. The question is, though, that since they're already sold out on a lot of their data center compute, these would have to be new deals coming in for new data centers they're going to build that they didn't even announce yet. So they're probably, if they do announce new deals, they're probably going to announce more data center building, or I guess contracted power that they're going to be doing. Anyways, we have reported the numbers because it looks like Nebius is moving right now. And we are down 6.22%. Up or down, I don't trust this move. I want to see things happen a little bit. Let me take a look over here to see if we got the numbers on the trusty rusty stock tightened. Yeah, it's like a knee-jerk move. So, who knows what the numbers were. Yeah, I don't see anything on stock Titan. The latest thing I see is that they acquired Tavily, which we already know about. So let's see here. I'm trying to take a look at Twitter to see if anything came out. Stock Titan is usually pretty fast with it. Yeah, this thing is just going to bounce around. I wouldn't, unless you're planning on buying or selling or trading this, I wouldn't really look too much in this price action. That's why I don't really believe it. Like, I need to see the earnings call. I need to hear the earnings call. I need to see the numbers. I need to see how it's going to perform when the market's open, because we've seen both directions with this, and you're never going to know until we do get that. We do get maybe like 2 or 3 days after the company reports earnings. It is making a newer low after the print, down 8% now. I don't see anything. I don't see any numbers. So this must have been through a Bloomberg. Oh, okay. Here we go. I do see revenue is up 547% year over year. Here we go. I'm going to share the entire window so I could share both things on there. Yeah, I don't know if you're kidding around. Good night. It's down. It's down 8%. I'm going back to sleep, guys. I told you I was gonna end the stream. I'm going back to sleep. All right. Let's see here. Do I got the numbers here? No, I don't have numbers. I do see this on Twitter. I don't know. I don't know. I mean, I don't think anyone's gonna like fake this or anything. So we got revenue, yeah, 35.2 is what we saw. We have 227. So the estimate that Wall Street had for this quarter, it actually undershot the estimate, I believe. According to, yeah, so the estimate was 238 million. They came in at 227 million. Still grew, but it's not what the street expected. Adjusted EBITDA loss was positive 15 million. Really? Wow. That's actually pretty good. Positive 15 million. Okay, I'll take that. Did they post on their website? No, it's not on the website yet. Actually, hold on. Yes, we have it on the website. Here we go. Here we go. All right. So these are the numbers. Wall Street expected around $1.4 billion ARR over here. Contract capacity year end 3 gigawatts. So they increased their, yeah, they went from 2.5 gigawatts to greater than 3 gigawatts for the end. So they must have signed a new contract. Do I sign, or maybe they have more contract capacity, but they don't have a new contract with a hyperscaler? I don't see anything here. Yeah, they're expanding their footprint, 9 new sites in the US. Yeah, 3 gigawatts capacity by the end. We remain on track to reach 800. Okay, so they're on track. That means they continue to execute, which is great. We deliver. Okay, so yeah, they said that they were going to deliver Meta by the end of the year, and they did. So that's good to see. They're already servicing Meta. They already mentioned that last quarter that they're already servicing with existing compute, so it wasn't like they had to build anything new. They already finished they delivered the first tranche of capacity for Microsoft. Good to see. $3.7 billion of cash. I mean, they're going to need it. It's very high capex. Tavily. No deal. There's no deal here. All right, that's fine. I didn't come in expecting it. Maybe the market expected it. I mean, don't come into these things expecting like some grand old news. It's very likely if they did sign a new contract, they're probably not going to wait until earnings to announce it. So maybe sometimes they do, but right now it's about execution. Yeah, Averide. Okay, so they would have had it all the way in the front if they actually did announce it, unless I'm missing something here. All right, so I'm going to leave this here for a second while I do check out the CNBC real quick, see if someone's talking about it. Yeah, they're down about 4.5%. Again, I mean, I don't know. We'll see. We'll see if that sticks, baby. We will see if that sticks. Nate is live. The dude lied to me. You lied to me, Nate. It's all good, but you did have a typo in your thumbnail. So I'm not going to take that away from you. How do you have a typo in your thumbnail? It's so funny. It's an honest mistake. I have mistakes like that too, but it's funny how people have there's like typos in the thing. All right, let me see. All right, there's nothing on CNBC. Let's maybe it's live. Let me see. Let me take a look at the CNBC. See if they got something live on here on the CNBC. Here we go. The squad. All right. I don't see anything talking about Nebius on here. Oh. No, they're talking about Bitcoin on CNBC. So I'm going to leave CNBC running in the background if I see anything. And How we doing? Okay, yeah, we're moving around. We'll see what happens. We'll see what happens. That was the knee-jerk move. We go green here. You know, we could be celebrating. It means I'm not going to be going to sleep. But you know, the numbers, it doesn't. Okay, you missed estimates by $10 million. Like, guys, that's like rookie numbers. $10 million. Who cares? You know, it's not. The real numbers are going to come out at the end of the year. I wouldn't focus too much on numbers that come out today. And the market's going to do whatever the market does. There's nothing you can do with the way the market's going to react to this earnings, guys. Like, it's going to do whatever it does. Yeah, bye-bye. I'm going to bed now. Everyone freak out. Everyone freak out. Nah, it's all right. It's all right. It's all right. We've been in this one for a while, so it's not going to change much. I mean, if it goes back to $23, it'll be time to freak out, but in a good way. And it would be pretty undervalued if it went down to $23 because they would have to, one, lose a deal with Microsoft, but two, they'd have to lose stake in ClickHouse and they have to lose a couple of their businesses. We just went green here. There we go. Never trust the move. I don't trust that one either. Devil, even if you go green, I don't trust you. I don't trust you, baby. I don't trust you. So we will see with that one. No problem. Thank you for coming in. All right, let's dig back into the earnings numbers. I'm still waiting to see if we're going to get some coverage on this one from CNBC, but no, there's nothing. They're talking about Bitcoin volatility right now. There's nothing on here. Yeah, it's very. I'm not really expecting anything on CNBC for this one, mostly because it's not like a super well, it is a popular stock in the resale community, but like they usually report in like very popular stocks. Grab is back to flat. Yeah, I did notice that last night. That is, or I did notice that this morning. That is good to see. Last night it was not, but it's all good. I think they must have had the earnings call, and that turned out to be a lot better. Or maybe just the algos. But, you know, we've seen Grab do some crazy moves in both directions. So, again, not really something I'm too worried about on that one. So let's see over here. So $1.25 billion ARR. All right. So it actually came out. No, I think I had $1.44 billion. So that came out a little bit less than what I had estimated. Guidance is still $7 to $9 billion. So that's good. They're still on track for that one. So again, whether or not we actually get that figure that people were not looking for this quarter, it doesn't matter because they're still guiding for $7 to $9 billion, right? So even if they were to hit the low end of the range, they're still on target for that. So whatever they miss now will be made up later on, unless of course they're going to be in the upper end of the range, which is good to see. We saw that last year, they actually hit the upper end, or earlier this year in January and in April as well. They were hitting the upper end of their range, and they kept on raising their guidance. So we'll see what happens with this quarter so far. But this is the last quarter of 2025, so it's not 2026 yet. So likely next quarter we'll get some more light into their $7 to $9 billion guide. But again, it's not really something that's supposed to be taken too seriously as far as like being in the upper end of the range or the bottom of the range. It still needs some time to play out, right? And even a $10 million miss is not really going to change anything as far as the thesis goes. So let's go over this real quick. 16 new sites. That's what their current guidance was, or that is what they're expecting, 16 sites. And sites with 100 megawatts or more are in circles, so that's good. So these smaller ones over here, like this one was already built out. This is a new co-location. So co-locations are not full stack for them. It's very likely they don't own the land. They're just either building servers on some racks inside someone else's data center, most likely, and that's the reason why it's not greater than 100 megawatts. For this Kansas City one, this one's been here for a minute. That one they did build from bottom up by their own. For this one, New Jersey, this is the one that they're building, of course. Part of it is online, or maybe all of it's online, actually. I think this one they're still working on. They're going to add more capacity, but it's already over 100 megawatts capacity. Newly owned sites, we heard about this one, the land that they purchased in Alabama. Oklahoma. Oh, what is this weird thing over here? I think this is This is the one. Okay, this is the Oklahoma one, new co-location. Yeah, Alabama's one that they bought the land in. We already know about the Iceland one, the Finland one, the Israel one they opened last year. Co-locations also in Israel, France co-location, and then the big data center in France, the big data center in UK, and then their headquarters, of course. Nothing really new there. This is actually interesting here. 24% adjusted EBITDA margin. They did come in. Yeah. So then they came over here, positive adjusted EBITDA for the first time. It's good to see. I think that was on time. We might have been expecting that this quarter. If I take a look at the fiscal AI here real quick in the back end, we are seeing here that I'm just bringing up the adjusted EBITDA here. So last quarter, they came in at minus 265, but this is not an adjusted figure. On an adjusted figure, they came in at positive 24% margin, $33.7 billion cash, core AI business, 800. Okay, so they see the core AI business is growing 800% year over year to 214 million. So right now, the core business is $14 million less of the entire thing. So it still grew very fast, and the core business is going to determine basically where we're at for the quarter. I mean, if the rest of the company is at $14 million, the core business is going to determine the growth rate of the entire thing. I don't think it really means that, oh, we're screwed, guys, because they didn't really grow that quickly or they didn't grow as much as expected. Like I said, I think it takes time for this thesis to play out. Valuation, January 2026, we already know about this, a $15 billion valuation. They have 28%, so that means they're about $4 billion or 3.75, I believe, $3.9 billion. So that alone is the market cap is $22 billion. So 1/4 of the market cap is ClickHouse, right? I personally think the rest of the business is worth more than this. But I mean, you know, this is trading down to like $16 billion just the other week. So that would mean that, you know, they're really pricing out. Like the floor is higher on this than most, right? Because they're a very diversified company. Launch commercial robotaxi in December. Oh, I don't think I remember seeing that. Maybe I missed it. Anyways, they have a strategic investment from Uber for Avride, which you already know about. Triple 10, more of the educational business, grew 88% year over year for the entire year in 2025. That's good to see. Toloka is the one that a lot of people know about. Didn't really have anything new to report on this slide for that one. We already talked about the ClickHouse. Yeah, so really nothing magical here. Probably a bit less than what Wall Street was expecting. Just looking at CNBC real quick. I don't see anything on Nebius. Nothing on Nebius yet. All right, so $1.25 billion ahead of our most recent guidance. Okay, so that's good to see. Yeah, they beat the guidance for the entire year. So that's good news. Wall Street was expecting more, though. So, of course, Wall Street will bring it down if they are not impressed. Group adjusted EBITDA turns positive in Q4. Good to see. Rapid expansion, as we read earlier, we ended the year with 170 megawatts of active power versus our target. Okay, so that's good. They have more power than they expected at the end of the year, 70% higher. So it's good to see. Significant build out AI platform. We already heard about this one. Token, expanded plot proposition. Good. Yeah, we already know about that one. On track to end at the $7 and $9 billion ARR. Good. I mean, that's what we want to hear. If that was less, we'd be way more red, but they are on track. And we already read the 3 gigawatts they had. So they're guiding for around 500 megawatts capacity more than they were last quarter for the end of the year. We remain well to reach connected power by the end of 2026. So contracted power is different from connected power, right? So contracted power is how much they plan to build. Connected power is like actually online. So they're basically going to have a gigawatt by the end of the year, right? At most a gigawatt by the end of the year. They already announced the Microsoft. Am I sharing the right screen? I'm not just like reading over here and there's nothing in here. This is a core position for me, meaning that I'm not going to sell it, not like an IREN. But it's not the largest position in the portfolio, if that's what you meant to ask. So I don't really see. They announced this the other day. Tavily announced earlier this week is just one example. Tavily extends Nebius cloud platform capability to the agentic AI, which we already read a couple days ago. $3.7 billion in cash. First quarter of operating cash flow positive, boosted liquidity. Okay, so that's actually, I believe that's actually not adjusted. So it's good to see, unless it is adjusted. We have to take a look at this stuff later on. Discipline approach. Yeah. Nothing really new here. They started deploying system 2025. Okay. I think we already. Oh, actually, this is pretty new because they did it in the US. They were just talking about EMEA before. So that's good. Yeah. Nothing really new here. Genesis Molecular AI. So they're getting to health, which is good. Those are usually pretty sticky businesses, and they usually expand pretty quickly. Yeah, I don't want to go through this entire thing, but there's definitely nothing like a new deal or anything. But I don't know. Maybe that's what the market was expecting. They're expecting a new deal to be announced. I wasn't expecting it, but it's all good. I mean, that would have been a nice plus, but I don't think it would have really changed anything. So that an extra 500 gigawatts of capacity for the end of the year and no contract signed. So it must have been a bunch of small clients or something, or maybe they're going to announce it later. But that is half a gigawatt of capacity that they expect to be contracted by the end of the year. So they're definitely expecting some sort of extension of a deal or a new deal. They just haven't announced it yet. Grubhub, White Castle, White Castle. 1010, 88% year over year. Full year enrollments, 55% year over year. Oh, okay. So they are accelerating in Latin America a lot more, just like they promised. That's good to see. New student growth, 5,800. 1010 is basically an education platform for AI products, usually for coders and developers, but everything, the entire stack. So you're definitely getting a lot of enrollment. That's usually going to be enterprises that are signing up. So that's always great news. All right. Nebius Academy, 25 new programs, including cybersecurity. Yeah. So it's like basically for engineers and IT. Nebius Academy launched September, is gaining traction as B2B solution. Okay, good. So that's business to business. That's so enterprise contracts. So those are big signups that they're getting. All right. 1010 continues to utilize AI to drive further operation efficiency. Of course, ClickHouse stake to Loco as a leader. Leading data provider for LLM and Gen AI development, and we no longer voting control to. Oh, I think they already said that though. Yeah, when Bezos Expedition came in, and this actually now the CTO of Shopify joined the board. And Bezos came in. They got rid of the voting control of the company, which means they don't own more than 50%. They do remain majority interest. Yeah, I mean, if you don't own 50%, that they're selling part of the business away to create more capital. At the end of the day, we all know that Nebius is using its other businesses to supply its core business. So if one day they sell more to Loca or they sell their position out into Loca, that's not going to be surprising. I don't think they're going to sell out, but I do think that they're probably going to sell more parts of it, if anything. We already heard about the $400 million, $15 million valuation, owns a significant majority stake. All right, the numbers, here we go. So 2025, 227 million, undershot Wall Street's expectation. 12 months ended, 598 million. All right, so this would put them at 529 million for the entire year, almost 500% growth. Do they say, yeah, the annualized run rate 1.25 billion, which is what we saw on the first slide. I mean, they are executing, they're beating expectation, but they missed the number on Wall Street by $10 million, which again, it's not really a big deal. Looks like we're going flat now in the stock. It's going to do whatever it does in the after hours. We'll get more of it as we go through the earnings call. Earnings call is not for another 37 minutes. So we got JC mentioned in the report, checks out. Yeah. How is Avride doing? Before I moved out of Jersey City in August, the robots showed up late in June, everywhere in 2 months. Yeah, there's a lot of robots driving around everywhere. I saw one like a few blocks away from me in Sherman Oaks. I mean, there's a lot of these robots everywhere. I don't expect Avride to like bring in material revenue because the rest of the business is only $14 million. So it's not really going to make a huge difference. I think their stake in these other businesses matters more than anything. So it's not going to like dramatically change anything, even if it grows by like several hundred percentages, right? So it is good news, but I think their stake matters more in it because they do want to create capital. They can always sell parts of their other businesses, which wouldn't really be a big deal. Beyond our core AI cloud business, Triple 10 contributed 60% of the group revenue in Q4. Oh, wow. So Triple 10 is actually a lot of the revenue. But they don't, yeah, they don't break down the other businesses like they did in the previous earnings before. They used to, but they don't do it anymore. But they did say that Triple 10, 6% of group revenue in Q4. Hold on. Let me just do something here real quick. Oh, they changed the logo for Triple 10. Hold on. Just want to post something real quick. I don't see anything on CNBC about Nebius. Yeah, there's nothing on here about Nebius. All right, so I'm going to bring this one up real quick here so you guys can take a look at this one. And oops, I'm going to give you guys this in the comments in case you want to check it out. That is the slides, or you can just go to Nebius IR and take a look at it in there. Stock is doing what it does best, absolutely nothing right now. All right. How are the other guys doing in here? Oops. I mean, everything else is like basically flat. Like 1% move in Nebius pre-market after the earnings. It's like nothing, right? That's how much it moves in like an hour, not even an hour. That's like 10 minutes. 10 minutes of a move right there. So it's not really going to break the bank. So, you know, we do want to see something happens at the earnings call. What are we going to get in the earnings call? I don't think we're going to hear anything new. If anything, there's going to be some analysts asking about like just getting some assurance at why they missed revenue by like $10 million. But you know, they're gonna say whatever they need to say. I don't think they're gonna say anything that's gonna drop a stock like 15%. I also don't think they're gonna say anything to make it pump out of nowhere. The algo is gonna do whatever the algo does best. Like it's flat right now. Pre-market, right? Nothing happened. Like nothing literally happened. Knee-jerk reaction here. But you know, these moves can happen. Like the last time we had the earnings call, they didn't say anything that blew us out of the water. In fact, it just seemed like the CEO just wanted to get back to work. He didn't really want to be in the earnings call. So don't expect any type of shorts commentary or anything like that in the earnings call, like the other CEOs and other companies. Arcady just wants to get back to work. He doesn't want to spend an hour in an earnings call when he can put that time into getting his job done. Hold on, where was my? I wanted to see something here. I'm looking at the earnings sheet again. All right, so not really much on the front here that I'm seeing is massive. But let's take a look further into the shareholder letter again. Shareholder letter again. 6% of revenue. Actually, hold on a second here. All right, so if they came in at 227 million. 13.62 million. You know, this doesn't make sense. This was their quarter. And the core business was 214. And this was all the revenue. And 6% is 14 million. It's the rest of it. So where's the revenue from the other businesses? I don't know. Maybe they got to break this down a little more. If I read this, is it just early that I don't really understand? Okay, so what I'm looking at here is that the total revenue for the quarter is 227 million. The core cloud business was 214 million, right? So that means you got about $13.5 million for the non-core businesses. And we had 10 grew 88%. And where did I read that it accounted for 6% of group revenue? Yeah, here. Beyond our core business, 10 contributed 6% of group revenue in Q4, which I calculated to be 13.62. So 10 is about $14 million or $13 million. The core business is 214 million. So that's 227 million. So where's the revenue from the other businesses? ClickHouse, they're not gaining revenue from there. They just have stake in it. Avride, are they not earning revenue in Avride? And what about Toloka especially? They should be earning some revenue there. I guess it's because that's just stake. I don't know. That doesn't add up. That certainly does not add up. I wish they broke down the revenue from each business segment, because then I would have more clarity, but they just like throw these numbers out there. Like 6% of revenue. Okay. Avride's revenue contribution Q4 and full year was immaterial. So it's negligible. They didn't say anything about Toloka. Toloka results have been reclassified to discontinued operations in current and non-current periods. Oh. So they don't include Toloka. That's why. They don't include Toloka. Avride has negligible revenue contribution to the quarter. And they just have stake in ClickHouse. They're not putting that in their revenue. So, in other words, the group revenue that we see of $227 million is literally just 1010 and AI Cloud, 214. This doesn't include the payout from the contractual power. That's where the AR is coming from. So we're probably going to see it next quarter is when it's going to start accelerating faster. Actually, not faster. It's not going to accelerate as fast, but that's when you start to see like the real numbers come in. Okay. Cost of revenues, product development. Of course, this is going to grow. Doesn't grow as fast as revenue, which is good to see. So total cost grew 669%. Revenue grew at 547%. That means that their costs are not increasing as fast as revenue. That means they're becoming more profitable. So that's always good news. And that's the same thing for the entire year. The entire year, revenue grew at 479%. Cost didn't grow as much as that. So they're getting more profitable on an operating basis. Cost of revenue, core business, okay. SG&A, product expenses. Advertising, marketing. You guys ever been to San Francisco? There's Nebius billboards everywhere. I didn't realize how popular it was in San Francisco. Primary driver dollar amortization was continued investments in GPU-related capital expenditures and related data power for core AI business for periods. We depreciated our server for over a 4-year period. Okay, so they're doing depreciation over a 4-year period. DA as a percentage of revenue declined 79 to 95%. From 95 to 79% as revenues grew faster. And yep, that's what we saw there. All right, here is probably the figure that we have for the adjusted EBITDA. Came in at $15 million on an adjusted basis. Good to see. 7% margin. $15 million in Q4, $78.9 million grew year over year. First quarter of adjusted EBITDA at the group level. Continued improvement, which generate. We achieved positive which generated $51.9 million adjusted EBITDA margin. We achieved positive group adjusted EBITDA despite Avride and 1010 recording adjusted EBITDA losses. So Avride and 1010 are not profitable businesses on an adjusted EBITDA basis. So I actually expected those to become profitable on an adjusted EBITDA basis before the core business. So the core business is now adjusted EBITDA profitable, what it seems like. CapEx, $2.1 billion, primarily driven by GPU purchases. So $2.1 billion in just that quarter alone. We are confident in our ability to deliver an increase greater than 3 gigawatts capacity in 2026. Following board review audit committee, the company plans to recommend that our shareholders approve the engagement of firm by the end of the year. Okay. They're going to have their earnings call in about 24 minutes. And this is all just statements here that we don't really need to be concerned about. All right, so that's pretty much it. That's pretty much it for the earnings. This was, regular execution. Nothing to sneeze at here. There really was no new news that we saw in this earnings. So, is what it is. It is what it is. Any coverage in this thing? I don't see anything on CNBC. Nothing. All right. Well, that was quite the quarter. The stock is up a small percentage here. The rest of the stocks here are just basically flat. What are we looking at the rest of the stock market? Oh, wow. The Qs are doing quite well this morning. I saw this thing just like it just went straight up since the futures open. Like it just did not stop going up. So that's always good news to see. I wanted to see what Meta's doing. Meta's up it's up a decent amount. How are Micron doing? Micron is up 3.5% pre-market. This thing is just running. Imagine if you had calls. Crazy. On semi is almost $72. Always good news. SanDisk is at 7%. Wow. Great to see pre-market. Nebius is up to it. Oh, wow. They're up 2.5% now. That's great. That's great. That's what they were before the print. Nothing changed. No, it's always laughable. Yeah. ASD Space Mobile, they had a dilution event yesterday. So the market didn't like it's like, what did you expect? Like, guys, if you're an ASD shareholder and you're surprised that they're raising capital, I don't know. Good luck. Hello, sir. How are you, sir? There you go. Appreciate it. Good morning, everyone. Good morning, Evan. Good morning, Stock Market News, SMN. There was something I wanted to take a look at pre-market, and I forgot what it was. Yeah, the software stocks. Let's see what Cloudflare is doing. Okay, Cloudflare is pretty decent right now. That was an amazing print. That was an amazing print for Cloudflare, but it literally just like gave it all, not all of it back, but gave like half of it back as soon as the market opened yesterday. And let's not forget about Shopify. But yeah, when the market opened yesterday, it literally just dropped like 10%. It's crazy. Crazy, that kind of move as soon as the market opens. I mean, it wasn't even as soon as the market opens. It was like over the course of a few hours, but like it just gave it back. Oh, Paycom is down 9%. Wow. Dude, are any of these... CNBC does not care about earnings this morning. Come on, man. All right, let's see here. I'm going to bring up the earnings hub real quick. Dump or pump? I don't know. Dude's like dump or pump. Is it pump or dump? Pump or dump, not dump or pump. But I don't know. We'll see what happens to the earnings call. I think it's just going to be algos just moving. So Paycom is down 9%. Let's see what's happening with Paycom. Why don't I see this in this earnings calendar? I'm pretty sure they reported earnings, right? Oh, they reported earnings after closing. Oh, okay. They were already down from yesterday. Yeah. So nothing really new. But why were they down yesterday? What did they say in their earnings report? It was probably the guidance. Yeah, the issue with Paycom was that the market thought they were cannibalizing their own growth with Betty, which is their AI solution. So Paycom, they basically are a payroll or like a mini ADP for like small and mid-sized businesses. And they released the AI called Betty, which basically solved a lot of their problems. Paycom really makes a lot of their money when businesses call Paycom for any adjustments or any fixes they need to do for their own payroll, and they get paid through services to that. But with Betty, it's able to fix these issues on the fly without needing to call support. So the market was really worried for a while that, hey, Paycom's business is going to be cannibalized by itself. Like, why are they doing that? And the stock bounced back pretty strong. This was a while ago. So it was when it was down here, when Paycom dropped after that crazy quarter in late 2023. And it took a little bit, but it finally recovered everything back 260. But like, yeah, it's trading lower. Is this an all-time low? No, but these are lows that we haven't seen since 2018. This software carnage is just insane, guys. Like, this is crazy. Like, the market is literally pricing these software stocks like they're about to go out of business. Like, Not all of these are going to make it, but if I had to pick some that are going to make it, definitely Cloudflare, because it's not necessarily a software stock. They do offer software solutions, but like they're basically DNS gatekeepers of the entire internet. And they also have content delivery network, which is basically hosting servers in close locations to people who are using inference, LLMs, or whatever compute it is. They're able to cache all of that and provide it faster. So like this is definitely something in there. So is DigitalOcean. DigitalOcean did not experience any drawdown recently. Congratulations to the shareholders for that one. Yeah, software is a little bit up today, which is always good to see. Oh, look, they already acquired. Maybe they completed the acquisition of CyberArk from Palo Alto. Mercado Libre is up 3%. Did they report earnings? No, they already reported earnings, I think. Oh, no, they report earnings in 11 days. Let me see here if there was some news. Robinhood is this back at $80? No, I think this is going to be back. If the market is bullish today, I think it's going back above $80 today. I did not buy the dip in Mercado Libre, unfortunately. Well, that's not really unfortunate. My average is much lower than here. I did buy the dip before in 2025, but I didn't buy the dip recently. I just added like 10, 20 basis points in my position. My position is already built out with that one, so I'll just hold on to that stock. All right, so I wanted to take a screenshot of something here so I could see the whole thing. Well, where did it go? Where did it go? All right. Nope, it's gone. I guess that's the one. Hold on. Just taking a screenshot of something real quick. There we go. I just want to get a screenshot of the whole printout and don't see any coverage. No one cares about the rest of our brands. Scott Bessent is going to be talking, I believe, tomorrow. Let's see here. Tomorrow morning he's going to be talking on CNBC, so he's probably going to maybe say some stuff about the Fed. Oh. No. Yeah, there's nothing on CNBC that is even relatable to any information we just heard. Let me just bring this thing up. AppLovin is down 7% still. That was a crazy bounce we saw yesterday after hours. It went all the way down to here, $406, and then it bounced up and then it just fell again. That was crazy to see. Yeah, it bounced up here. It almost actually went green after the earnings and then just dropped again. I didn't get to review what happened at AppLovin's earnings call, but or even the earnings itself. I just think the market just doesn't believe that. Just doesn't believe in ad tech. I mean, to be honest, like even Reddit was up a lot after the earnings, and like, look, they just dropped massively, right? Like this is why it's like the way the market's working right now is that it does not care what you post in your earnings. Like it's like it's already made up this decision of what it's going to do to you after your earnings. So it's very difficult to say like where is Nebius going to be after the earnings. Like I don't know where it's going to be. The market's going to do with Nebius whatever it does. Like yeah, it's up like 3.2%, which is great to see, but like it's going to do whatever it does to it at the end of the day. I think we're at a point in the market where if you're not in picks and shovels. And data center should be picks and shovels, but the market doesn't certainly think so. Picks and shovels would be like up here, right? Your semiconductors. And if you're not here, then like we're just going to dump you on everything, especially software. And besides Oscar, but that's because they dumped Oscar all the way down there. So Oscar had a considerable bounce down to $11, $10 actually. So congratulations to anyone who's caught that move. Shout out to anyone who owns Oscar. That was a crazy move. But yeah, software is just not, it is not the place to be right now, it appears. And I haven't bought the dip in software. And there's no reason to. I don't like to buy falling knives unless I'm strategically building a position out. But no, I'm good. I don't want to buy software right now. I don't need to call the bottom. I'll probably buy it once it starts recovering. Oh, look at that. Bitcoin is up a little bit. Ethereum is not above $2,000, but it's making some moves here. And financials are doing pretty decent. I'm still in Rubrik. What they got to remember with Rubrik is that my average of Rubrik is like the bottom. Because I massively built my position like right after IPO. It wasn't as big as I hoped it was when I first bought it. I was in a much different strategy for investing. I was like, oh, buy and hold, or own things like at a very cheap price, whatever. And other positions were sized heavily. So, it is a double from here. I already got a double, but nothing like that's going to move the bank for me, right? So I don't know what the percentage is. It's just like a couple of percentages or a few percentages. Like it's not a massive position. I did unload some when it was like $110 or $106 after the earnings before, but like not even a lot. Just trimmed a little bit. And I have my core position in Rubrik. Yeah, no, there's no need to catch the bottom. You don't, if you keep on trying to catch the bottom, buying in tranches, you're going to run out of money. And if you keep on running out of money, you want to buy more, you might be encouraged to open a margin and stocks can go lower. The market can remain irrational longer than you can stay insolvent, right? So that's just, we got to know that, right? I don't like to buy falling knives, and it's helped me out this year so far. But yeah, the bottom of Rubrik was like $28. So my average, I was accumulating a lot on the low end here. So I did add to it like a small amount at $80 because it bounced out the 200-day moving average. And then look what happened, right? So if I pull up, we got earnings call in 10 minutes. If I pull up this chart here, after they reported the last quarter, the thing shot up, right? That was great news. And then I remember after hours, something happened with Rubrik. And then I added around like 85 or something because it bounced off like the 100-day or something after hours. I didn't add a lot, like just a few, just not a lot. Like I didn't like, oh, this is the bottom, right? But the market was in a much different place in December. And then I haven't added since. And this is why I don't add to it, because one, my cost base is low, so there's no reason to. But two, this isn't a Rubrik problem, guys. All this red is not a company problem. Well, it might be for some, but this isn't a software problem. This isn't a Rubrik problem. This is a software problem. And it's not even a software problem. This is an AI problem, right? So ever since we basically got DeepSeek 2.0 for software, it was a fear that, look, AI is going to replace software. We're not going to need to have software sold to companies when they could just build it in-house using AI. And the thing is that it's cybersecurity. You're not going to build your own in-house cybersecurity product. You're going to hire people to do it for you, or you're going to buy a product off the shelves to do it for you, mostly for compliance purposes, for costs, training people the inside to do all this. Like, you're going to hire people to do it, right? And there's much more to it than we could even think about. Why would you build it in-house? It doesn't seem like the best move to do for companies, but the market doesn't think so. The market thinks that these are all going to zero, apparently. And that's how it thinks today. And there will be a day where Rubrik's going to be back up there. Unfortunately, it's not today, but the market is always right? The market always makes a decision. That's a price you see in your chart. And when the market changes its mind, then it'll be higher. But until then, Rubrik is a sound cybersecurity company and data security background. If I were to bet on cybersecurity companies, I'd bet on CrowdStrike and Rubrik. Those are the only two I'd bet on. The other ones, like Palo Alto, is going to be around for a while, but I think a lot of the upside is sucked out of Palo Alto. You'd have to wait like years for the valuation catch up. CrowdStrike is expensive, but the market is clearly in favor of CrowdStrike, right? Like even look at the chart. It is below the 200-day moving average, but like it's still really up there. It's still expensive. And the market's giving it that premium because it's the leader in cybersecurity endpoint technology, and they're becoming an entire platform. Datadog is just, it's observability, but this is open for disruption. I can't be like bullish Datadog long term because like I've even worked at companies where we've built our own in-house solutions, or even whatever AWS or Google Cloud or Microsoft offers. It's not good enough as good as Datadog is an extraordinary product. The thing is that like it might be good enough for some companies to not sign up with them, and that's going to stunt their growth, and that's going to be an issue later on. But I mean, you know, I could be wrong, but that's just my thesis with it. The stock market obviously gives it a premium because Datadog is one of the best companies out there in terms of management, execution, balance sheet, income statement, right? They're getting much, I think they are actually a profitable company now. Observability is a commodity at this point, but Datadog does have the leading solution out there. So it will take a while for something else to come along, but I don't think anything else is going to come along. They're innovating so quickly. But the problem is that I don't think it's going to be a Datadog problem. I think it's going to be an observability problem when it comes to AI. And ad tech, I never understood why they're selling ad tech off so much. I don't understand why. And it might be because the dependent businesses is probably what's causing fear. I mean, obviously Coinbase is down because of Bitcoin. But like Toast, Shopify, I don't want to get to PayPal, but like all these other businesses, like why are these down? Like I don't understand why. And they post good quarters. Like Shopify had an amazing quarter, but they just dumped it at the open. So my only attribution is that it's because the market just doesn't want to buy these stocks. All right. So depends on your time frame. Unfortunately for me, I'm not looking to buy these stocks right now. All right, so let's see if they have coverage here. Did we get retail numbers? No, it's too early to be getting any numbers on here. Hold on. Looks like they're just checking out jobs data here. I can't believe they didn't report on any earnings this morning, especially with Rubrik. No, it's not a Rubrik, Nebius. Let me see if other channels covered it. Yeah, there's even on like Bloomberg, like there's like nothing. Yeah. There be nothing. There is nothing on it. So I guess we have to wait and see. I'm going to bring up the earnings call. In the meantime, there were a few things that I wanted to play for you guys. Hold on, where is it? Here we go. Yeah. Tom Lee did talk yesterday on CNBC. It's always interesting to hear what he has to say. I don't know. I don't know where crypto is going to be, but it's certainly not in favor right now.
Tom Lee, he is FundStrat's managing partner and head of research. Welcome back.
Great to see you, Scott.
So what do you make of the price action today? This was a undoubtedly better than expected jobs report. Yields ticked up, maybe expectations of cuts by the Fed ticked down. We're trying to just figure it all out today?
Yes, I think the macro is a little confusing for investors at the moment because we not only have a new Fed chair that's announced and his policy stance isn't clear, but I think investors have been thinking AI was going to eat the jobs market, but we have a pretty decent jobs report. I think it's going to put a lot of weight, and we of course had a weak retail sales, but it's going to put a lot of weight on Friday's CPI report, because if that comes in tame, at least the market can understand that the inflation part of the Fed's equation is cooling. And of course, now if the job market is showing decent strength, it kind of relieves us from a macro perspective, because at least we're not seeing an economic downturn.
How about the fact that the market's been a little frazzled? That's the word I've been using today lately. Bespoke points it out. For the first time in history, the S&P went from overbought to oversold, back to overbought in a week or less. Goldman's Tony Pasquarello, Tom, says he can't recall a time that was this noisy, this high velocity, this wide open. What about you?
It's very confusing, Scott. I think that there's two things happening, but I think one is really the bigger effect. I think the smaller effect is that AI, as you know, has gone from being this sort of driver of S&P earnings. Now the market questioning, is AI just wrecking tech so badly that it's bad for the stock market? And also, they're not buying the data centers and hyperscalers anymore. They're actually trying to buy the bullets, not the armies. But I think the bigger effect is that gold has become like this singular monolithic trade that's worked. But gold now is a $40 trillion market. X the Mag 7, the S&P's 40 trillion. Gold is now bigger than the stock market. So I think as gold rises, I think investors are wondering, do they really want to use stocks as a store of value if they can just be buying gold?
Man, I just feel like we're kind of going down the line of the AI shooting gallery. And first you take down some of the mega caps, and then you take down a lot of software, and then you take down some of the private credit names, and then you take down some of the financial data related names. Is that just how it's going to be? We're just trying to guess on who's going to be disrupted the most?
Well, I do think AI's capabilities, Scott, are showing improvements, maybe, as they say, doubling every 7 months, and now it's going from mediocre to quite good and substituting some jobs. I think that, of course, is rattling markets. But at the end of the day, and this is a half-full perspective, it's kind of proof of productivity. So to me, I think what we're seeing is that there is a payoff coming from AI, because for software companies, for the ones that are actually truly disrupted by AI, that actually is a cost savings for a client. So I think it ultimately is productivity.
Tom, when someone like David Einhorn comes on today and says, quote, "I think this is the most expensive market that we've been in," can you argue with that? I mean, you can say that it's pricey. Others would say, well, it's justified because look at how earnings are beating expectations. How do you parse that out?
Well, I mean, on a relative basis, his statement is correct because, as the late Art Cashin said, bull markets don't die of old age. They get murdered by the Fed. So every year, the market does get a little more relatively expensive, even if earnings are good. But this year is pretty unique. Earnings growth is accelerating. The ISM is back above 50 after spending basically 3 years below 50. We have a new Fed that ultimately, I think the market is concluding is dovish, and David Einhorn actually believes he's dovish. So that's supportive of multiples going up at a time when the stock market has been shown 6 black swans, from all the way from COVID to the tariff disruptions, and still grew earnings. So I think the market's going to have to start to give a higher PE to the equity market, just in the same way that gold's being re-rated at the moment. Gold's PE multiple, price to sales, I think is over 50 times right now. So if gold can re-rate, I think equities can re-rate higher.
Lower stocks after that better than expected jobs report.
So he's bullish gold, obviously. He doesn't really talk about Bitcoin anymore. Like I mentioned before, he is picks and shovels. That's where the market is looking right now. It's looking at semiconductors and everything in the supply chain. And that's the reason why I've opened positions in those, because that's what's working right now. And, you know, you got to go with what the market's working. If you want to like truly outperform the market in like every year, like you can't just buy and hold, right? Because the market doesn't go up infinitely, right? It doesn't go up in a straight line. And in order to sustain that growth in the portfolio, you have to be quick and you have to be dynamic in terms of how the market moves. And that's just exactly what I'm doing. I am moving with the market. And I think that these themes are going to work for a while. They've been working for 3 years. And I think it will continue to do so. Was trying to do something here real quick. Hold on. All right, I'm going to bring up their earnings call. Should be started now. Here we go.
At any time during the presentation, and the Nebius management team will try and answer as many questions as they can during the Q&A portion of the call. I will now hand over to Neil Doshi, VP Head of Investor Relations, to start the call.
Thank you, and welcome to Nebius Group's fourth quarter 2025 earnings conference call. My name is Neil Doshi, Vice President of Investor Relations. Joining me today are Arkady Volozh, Founder and CEO, and our broader management team. Our remarks today will include forward-looking statements, which are based on assumptions as of today. Actual results may differ materially as a result of various factors, including those set forth in today's earnings press release and in our annual report on Form 20-F filed with the SEC. We undertake no obligation to update any forward-looking statements. During this call, we will present both GAAP and certain non-GAAP financial measures. A reconciliation of GAAP to non-GAAP measures is included in today's earnings press release. The earnings press release and shareholder letter are available on our website at nebius.com. And now I'd like to turn the call over to Arkady.
Thanks, Neil. And thanks to everyone for joining this call. Well, 2025 was a very strong year for us. Our team did an outstanding job scaling capacity and delivering it to customers with speed and reliability. We also made great progress in developing of our own hyperscale AI cloud. But before going into more detail around our 2025 results, I want to take a step back. It's hard to believe we only launched this company a year and a half ago. At that time, we have built the foundation of a global AI cloud business growing at exponential scale. And we have been operating with very high intensity, building and scaling at extraordinary speed. Today, we are already one of the world's leading and most reliable AI cloud compute providers. We have attracted a diverse pool of clients who value the quality, performance, and flexibility of the platform we built from the ground up. And we have an amazing team who every day seem to do the impossible. And I know they will continue to do so. With this foundation, we're proud of what we have achieved and confident about what we will be delivering. Now back to 2025. As I said, it was an excellent year. We exceeded our financial targets and we significantly exceeded our capacity plans, setting the stage for the next phase of scale. Demand remains robust and our pipeline continues to grow substantially. We sold out of capacity in Q3 and Q4 last year, and we're already now in Q1 of 2026 also sold out. Even before we bring capacity online, it's often sold out. As a result, the average contract duration of new cloud customers grew by 50%, and the prices of GPUs didn't fall, even on previous generations of GPUs, as the industry may have expected. Customers are demanding more compute and increasingly sophisticated solutions to run their AI workloads. AI startups are quickly evolving to real enterprise scale customers with revenues from their products resonating with real customers. Their demand quickly grows from hundreds of GPUs to tens of thousands. This is already a range the market saw from the biggest customers last year. We're seeing the same trends in the enterprise, who are utilizing AI for more and more vital business processes. Meanwhile, access to compute remains constrained. This imbalance creates a favorable environment for us as we secure and deploy more capacity into a robust demand environment. To capture this opportunity, we are accelerating our capacity plans. Just today, we announced 9 new data centers across the globe. Last quarter, we said we would secure 2.5 gigawatts of contracted power by the end of the year. We are already at more than 2 gigawatts now in February, which is why we are raising our forecast for 2026 to more than 3 gigawatts. And we are well on track to deliver 800 to 1 gigawatt of those as available data center capacity, just like as we spoke about last quarter. Capacity is one of 2 dimensions of our growth. The other is product. Our main strategic focus is to scale our core AI cloud business, which is our multi-tenant AI cloud. We will expand our platform both organically and through targeted acquisitions that can enhance and accelerate the development of this platform. We recently launched Token Factory, and this is an example, a testament actually to our in-house capabilities. And we're also very excited about our recent acquisition of Tavily, which adds agentic search capabilities to our customers, and also brings almost 700,000 developers to our ecosystem. Based on the strengths in demand and our strong execution, we remain confident in our plans for a year ahead. We are reiterating our annualized run rate revenue of $7 to $9 billion by the end of 2026. When we announced this target 3 months ago, there were questions about our ability to get to this range. Over the last few months, our conviction in this range has become stronger. Why? Because we exceeded the high end of our 2025 ARR guidance and showed more than 1.2 billion ARR. Because we already contracted more than 2 gigawatts of capacity and are on track to exceed 3 gigawatts this year. Because we have already delivered all of our capacity for the Meta contract. Because we are on track to deliver the capacity for Microsoft through the course of 2026, exactly as planned. And lastly, the demand for our AI cloud continues to be strong. Pricing is strong. We're seeing more and more customers coming into the platform and committing larger and larger and longer contracts. Everything we build, we sell. We're in the very early days of one of the biggest industrial and technological revolutions in history. That's what we believe. And Nebius is quickly becoming the AI cloud provider of choice. I want to thank again all of our employees for their dedication and hard work, as well as our shareholders for your trust and support. And we will continue to deliver. Well, now I would like to hand the call over to our CFO, Dado Alonso. Dado, please.
Thank you, Arkady. Indeed, 2025 really was a fantastic year with great execution and delivery. We exceeded the targets we set, outperforming our ARR guidance and achieved positive EBITDA at the group level. We also raised significant capital to fund our growth during the year. Now, let me provide some color on the results, discuss our financing plans, and then I will conclude with 2026 guidance. In Q4, we delivered group revenue of $228 million, representing year-over-year growth of 547%. Revenue grew 56% from Q3 to Q4. Annualized run rate revenue for the core business stood at $1.2 billion at the end of December, exceeding the high end of our Q3 guidance range of $1.1 billion. The results of our core AI cloud business were even more impressive. Revenue grew 830% year-over-year and 63% quarter-over-quarter. This was driven by high utilization, strong pricing, and strong execution. As Arkady noted, we sold out our capacity once again in Q4, as demand continued to significantly exceed available capacity. Even as we delivered such strong growth, operating leverage and spending discipline enabled us to achieve notable progress on the bottom line. Group adjusted EBITDA inflected positively in Q4, consistent with our guidance, driven by the strength in our core cloud business, where adjusted EBITDA margin expanded from 19% in Q3 to 24%. Turning to the balance sheet, we ended the year with $3.7 billion in cash and cash equivalents and generated $834 million in operating cash flow in Q4, which was primarily comprised of upfront payments from our long-term agreements. These early cash flows will continue over the course of the year as we execute against these commitments, providing us with significant visibility into future cash flow. Our cash on hand, projected operating cash flow, and strong balance sheet position us very well to fund our capacity build-out plans for 2026. I will share more detail about our capital plans in just a moment. Now, I will turn to 2026 guidance. As Arkady mentioned, we remain confident in our ability to generate annualized run rate revenue of between $7 and $9 billion by the end of 2026. For the full year, we expect to achieve between $3 and $3.4 billion in revenue. Starting in Q2, we expect to begin bringing online some of the new sites we announced today, with the majority of the planned capacity to be deployed in the second half of the year. As of early February, Meta's capacity was fully deployed, and we are now fully servicing their contract. After delivering the first tranche of our Microsoft commitment on time, we expect to continue to deliver the remaining tranches throughout the year, with the majority expected in the second half. We expect Microsoft to begin contributing to revenue at the full annual run rate in 2027 once we have deployed all of the tranches. On adjusted EBITDA, we expect group adjusted EBITDA margin to be approximately 40% for 2026. We expect EBIT to remain at a loss in 2026 as we progress against our capacity expansion plans, deploy GPUs, and invest in R&D that will significantly enhance our technology stack and our future AI product. We believe the return on these investments are attractive and will remain committed to our medium-term EBIT target of 20 to 30%, with the potential to go higher. Starting in Q1 2026, we are updating our depreciation schedule from 4 years to 5 years to reflect what we are seeing in the market and in our current utilization commitments. This approach is aligned with accounting-based practices, and we continue to be conservative on this front. Now, turning to CapEx. In order to capture the large and growing opportunity that we see for the future, we plan to invest in CapEx in the range of $16 to $20 billion in 2026. We already have about 60% of the capital needed for this range from our balance sheet, existing operations, and commitments. We evaluate several funding options available to us on a consistent basis and will deploy 2 guardrails when we look at capital alternatives. First, we will focus on raising debt relative to our business needs and will be prudent with respect to the cost of capital. Second, we will be mindful about the shareholder dilution if we choose to issue equity. Given our balance sheet and minimal debt, we are fortunate to have many additional options to finance our growing business. For example, we are currently exploring adding corporate debt and asset-backed financing to a balance sheet. Our at-the-market equity program, which we have not used at all to date, remains an additional alternative for opportunistic capital. In addition, our equity stakes in ClickHouse and other businesses such as AV Ride can also be future sources of capital. We are excited about these holdings, especially as the market recognizes their significant value. As an example, it was recently reported that ClickHouse valuation was approximately $15 billion in the most recent funding round. So the wide array of funding options available to us allows us to fund growth in a way that is balanced, disciplined, and aligned with returns that rather than committing to a single path. In conclusion, 2025 was a year of strategic progress for Nebius, and we executed with focus and discipline across our business, generating strong momentum as we enter 2026. In the year ahead, we will continue to scale rapidly to capture the meaningful market opportunity in this once-in-a-generation moment in our space. And with that, I will turn the call back over to Arkady.
Yeah, before we turn the call over to Q&A, I want to provide one more update. After this earnings call, Neil Doshi, our VP of Investor Relations, is moving into a new strategy function role, and we would like to thank Neil for all his great work in building out of our IR function to date. And I'm also extremely pleased to welcome Gili Naftalovich, who will be our new VP of Investor Relations. Gili brings with her deep research and strategic finance experience from Goldman Sachs, UBS, and Manda.com. And we're very excited to have her on board. With that, let's go to the Q&A.
Great. Right, we are just collecting some questions from the portal, and we will begin Q&A in just a moment. All right. The first question from our investors on the portal is, Nebius is moving quickly to both bring demand online and to build strong foundation for the future capacity. What are you seeing in the market that gives you conviction that the demand for AI will continue to justify these investments? Let's give that to Arkady.
Well, first of all, we all look around and see what's going on practically everywhere. How we change our habits in everyday private lives, what happens in our corporations, in our company, for example, how much of workloads are now utilizing AI capabilities, including coding. And actually, we now see that all the industries actually are changing. Look at a recent example again, coding, or look at the movie industry, or look at the research. Whatever you do now, you do it with AI. But again, these are just general notions, but our conviction is mostly based on what we're seeing directly in our business. We see very clear signals in all sectors of our business. First of all, in the large accounts, all large clients are talking to us, and not only to us, but the whole market about expanding and renting more capacity, more GPUs, because their AI businesses are growing. There is this ongoing conversations actually will lead to more contracts everywhere. But we are, as you know, much more focused on our AI cloud business. And in AI cloud, we have these two major sectors, AI startups and enterprise. And look at AI native customers, what happened to them in 2025. Some startups disappeared, but some of them are becoming real companies, real enterprises of the future. And they started getting traction, their products became more and more, they're more and more used by their customers, and they're scaling quickly, scaling with real revenues, real demand. And what we see such customers, such companies who used to order hundreds of GPUs, thousands of GPUs, now they're ordering tens of thousands of GPUs. And this is actually is a magnitude of what we saw in the largest consumers last year. Frontier models were ordering tens of thousands of GPUs just a year, 2 years ago. Now it's yesterday's startups at this level. Again, this is real business. These are real customers of them paying real revenues. So AI traction is visible. There's a lot of customers from the sector, starting with Cursor or Rodo, Higgsfield, Photoroom, Genesis Molecular, different sectors, and they all have their first traction, and they're becoming, as we speak, becoming real companies. Actually, it's the future enterprises. And on the other hand, there's enterprise clients who involve more, and who are actually switching most of their everyday business process to AI and generate new profits through that AI implementations. We see the growing number of such customers, growing contracts from each of such a customer. The number of GPUs is growing. The duration of the contracts is growing. As I said, the average duration for new customers grew 50% last year. So from the signals we see from all the sectors of the market, from big clients, hyperscale labs, from AI startups, becoming enterprise clients, for enterprise going AI, everywhere we see positive signals, and we just need to build more for them, more data centers, more tools. And if we could build faster and even more than we have today, we would do it. So we're building because it's clear growth.
Great. Thank you, Arkady. Next question is from Josh Baer from Morgan Stanley, who asks about our CapEx financing plans. You know, especially now that we have 16 to 20 billion of CapEx guidance out there. You know, how are we thinking through to meet these expectations for CapEx? Ophir?
Hi, I'm Ophir Nave, the COO and board member of Nebius. Usually I'm not participating in these calls, but given the importance of this question, both for our business and as well as to the investor community, I will take this one. Basically, this question has two parts. First, what is the optimal capital expenditure for our business in 2026? And second, how is this CapEx, how this CapEx is going to be financed? And obviously these questions are connected, related. So let us start actually with the second question, or the second part. How are we going to finance the CapEx? So obviously, we will first finance it from our cash flows. We have our cash on hand. We have cash that is generated from our core business. But most importantly, I would say, we have significant amount of cash that we received and will continue to receive in 2026 from the favorable terms of our long-term contracts. We are talking about significant amount of cash. These cash flows will actually finance the majority, actually around 60%, maybe even more, of all of our capex needs in 2026. So how are we going to finance the remaining amount, the rest? So as we all know, we have a very healthy balance sheet. By the way, not by coincidence, because we are working very hard to have a very prudent, disciplined, healthy balance sheet. As of today, we don't have any corporate level debt. We don't have any asset-backed financing, even though we have multi-billion-dollar revenues from long-term contracts. We don't have any bank revolver. And we didn't have it to date by choice. But moving into 2026, and as we all know, an optimal capital structure in our business should include also debt. This should obviously be changed. And we plan during 2026 to use some of the tools that I mentioned in order to move toward a more optimal capital structure. So having said all that, from the financing point of view, we believe that the $16 to $20 billion capex makes a ton of sense. And we will be able to finance it while keeping a very healthy, disciplined balance sheet. But moving to the first part, the first question, what should be our optimal capex for 2026? I would mention, actually, Arkady said it time and again, that given that we are fully vertically integrated company, our capex is basically divided into three parts. Less than 1% is used for securing power. And given the importance of power to our business, and given the importance of securing power for our future hypergrowth, we are moving full force ahead in order to secure as much power as possible, given the relatively low cost of it. And I think that on this call, it was mentioned that we already secured significant amount of power, and we will continue to do so. The second part of the capex are building the data centers. This is approximately 20% of the total capex. And we invested in building data centers. We invested this amount, and it turned out, as we expected, that it became one of the best investments that we made. Why? Because when we have data centers ready, or almost ready, where we can deploy GPUs in a very short period of time, we can sell this capacity in very attractive and favorable terms. We have done so to date, and we plan to do it also in the future. We see the demand, we see the interest, we have a clear visibility on the demand for the second half of 2026 and for 2027, both from our cloud clients, as well as from AI labs and hyperscalers. And we are positive these investments, with the interest that we are getting from all these players, will play out again very beneficial for our company as it does so in 2025. The remaining part of the CapEx is obviously to deploy the GPUs. Again, this is a significant part of the CapEx. The beauty is that we deploy the GPUs in a short time period when we have a great visibility about the demand and about the prices and about our margins and we are very happy. We don't view it as a very risky place to be. So, having said all that, we believe that the $16 to $20 billion capex for 2026 makes the most sense for us. First of all, it is based on our visibility on the demand for 2026, 2027. It's based on the interest that we are getting from various players, both in our cloud platform and the AI labs and the hyperscalers. It will enable us to meet our $7 to $9 billion ARR in 2026. But more importantly, it will also put the foundation for our hypergrowth in 2027 and behind. But speaking about CapEx and investments, I think that it was worthwhile also to address two additional points. One is the ATM. As you all know, we launched our ATM program last quarter. As of today, we didn't use it at all. Actually, we don't have any concrete plans to use it also in the near future. However, it's another tool in our toolbox that will enable us to use it when it will make the most sense for our business as well as our shareholders. And this is another tool that will enable us to keep a prudent, balanced, disciplined balance sheet. And another point that I think worth mentioning is obviously our non-core businesses. We are fortunate enough to have our 25% stake in ClickHouse and our ownership in Everite. These non-core businesses, these stakes, are worth many billions of dollars as of today. This is great, but it's less interesting by itself. And most importantly, we truly believe that these stakes will significantly increase in the midterm. And when they will do so, they will enable us to continue growing our business in a hyper-paced mode as we plan 2027 and behind, while using this capital and continue keeping a very disciplined balance sheet. We're really happy with this potential capital injections for the future. I think that I gave an overview on the CapEx, the needs, and the ways to finance it.
That was very helpful, Ophir. Thank you. All right. Next question comes from Alex Platt, D.A. Davidson. Can you help us bridge to not only the 800 megawatts to 1 gigawatt of connected power guidance, but now to the 3 gigawatts of contracted power guidance by year end? Andre?
Yeah, thanks, Neil. Hello, everyone. So what we can see now is we are accelerating the build out and deployment of the capacity in 20. And we expect that the acceleration will continue in 2027 and beyond that. So what we are doing is we are, as Afir mentioned, we are doing the investments in building the foundation for the 2027 and for the further years. We are well on track of achieving our goals that we mentioned about 2026 of this 800 to 1 gigawatt goal around year end, and we do that by launching a lot of sites with a mix of smaller and larger projects, and some of our bigger projects starting to come online in the end of this year. And in addition to that, in addition to the sites that we mentioned today, we have a multiple ongoing projects, and we expect that some of these additional sites may materialize this year. So basically, we expect that the collocations will help us grow faster starting in Q2 this year and ramping throughout the year. And our own projects, which are substantial in size, will really start to ramp up in 2027 and beyond. And that relates directly to the contracted power.
Great. Thank you, Andrei. Andrei, maybe just staying with you. Andrew Beal from Arete is asking about an update on the New Jersey data center site.
Yeah, with the New Jersey, we are very pleased with the progress there. We delivered the first tranche to the Microsoft on time, and we are well on track to deliver the remaining commitments on time as well. We believe that our partners secured the components in the supply chain, and they're working extremely hard to get everything online. Well, we also have some safety margin buffer times in our projects. And well, all projects can have some fluctuation, but we have built our plans with a large margin of safety, and we have a high confidence of executing this.
Great. Thanks, Andrei. All right, looks like we have a question from Alex Duvall from Goldman Sachs. Looks like Nebius came in light on revenue versus consensus for Q4, but ARR was ahead of expectations. So which is the more meaningful metric, and are there any timing considerations? And then just more broadly, lumping this with the ARR question, can you help us understand the difference between ARR guidance of $7 to $9 billion and the revenue guide for 2026? So Dado, maybe you can take this.
Thanks. Let me take it one by one. On the first question, of course, we were very pleased with our ARR of $1.2 billion, which exceeded our ARR guide. Our revenue came in the middle of our guidance, which actually was what we anticipated. Look, as we are in a hyper-growth phase, ARR is the meta metric. Now, on the next question around the difference between ARR and revenue guidance, let me say that first and foremost, at Nebius, we are really taking a prudent approach to our revenue guidance as we communicated. In 2026, our guidance is $3 to $3.4 billion in revenue. The difference between ARR and revenue is logical. Our revenues and ARR reflect the deployment schedule of our capacity throughout the year, with the majority of this capacity being installed in the second half of the year, as Andrei mentioned. We need also to consider that our largest enterprise partnerships are also still ramping. So the revenue guide simply reflects the ramp up in capacity coming online.
Great. Thank you, Dado. Question from Alex Platt from D.A. Davidson. How should we think about your progress against the $7 to $9 billion of ARR guide? And are you really dependent on the large hyperscalers to get to that range? Mark, why don't you take this?
Thank you, Alex. First of all, let me clarify. Our 2026 ARR target is not dependent on any new mega deals. As we bring on our planned additional capacity, combined with the already strong pipeline and our go-to-market plans, we are very confident in our ability to deliver our 26 ARR target. Our continued success with AI natives and the early progress we've seen with ISVs and enterprises set the foundation for capturing the market this year. Based on the traction we are experiencing and our extensive research on our total market opportunity, we are leaning into the verticals we've already laid out: healthcare, life sciences, media and entertainment, physical AI, and retail, which give us ample runway to capture share and grow our business. While we are happy to service large strategic customers like hyperscalers, we will remain opportunistic with such large deals as we look to balance the opportunity with the long-term positioning we plan to achieve with our AI cloud.
Great, thank you, Mark. Now let's take a question from the portal. Can you provide an update on where you stand as it pertains to the delivery schedule with Microsoft and Meta? And remind us again about how those two contracts layer in throughout the year. Maybe on the first part, we'll have Andre, and then Dado, you can take the second part on the contract layering.
Yeah, thanks, Neil. As I mentioned earlier, the first tranche to Microsoft was delivered according to the plan in November, and the remaining capacity is on schedule, ongoing. All of the remaining tranches will be delivered throughout the whole 2026, and more than half of them will land during the second half of the year. About Meta, earlier in this month, we delivered both contracted tranches to Meta on time, and we just now fully in servicing stage. And Dado, can you comment the financials?
Of course. Thank you, Andrew. The deployments in Meta, as Andrew just mentioned, went live early February. As such, we expect to recognize 12 months of revenue for the first tranche and roughly 11 months for our second tranche. As for the Microsoft deal, we expect revenue to ramp over the course of the year in line with our plans to deliver the capacity tranches, which, as Andre mentioned also, will happen throughout the year with the majority expected in the second half. So Microsoft deal will begin to deliver a full year revenue starting in 2027. And as we execute on these commitments, we expect them to contribute positively to our medium-term EBIT margin target of 20 to 30%.
Great, thanks, Dado. Another question from the portal. What drove the upside in the December 2025 ARR? And as you look into Q1, what are the demand trends that you're seeing in the market today? Mark, why don't you take this?
Certainly. The upside in December ARR came from solid execution and strong pricing and utilization. We continue to make great progress in adding new logos and expanding with existing customers. On the second point, we are seeing very strong pricing across all families of GPUs, and we are at full utilization as we continue to sell out all available capacity. On Q1 demand, it remains extremely robust, and we are seeing the same trends that we shared in 2H25 carrying into 26. The three things that give me tremendous confidence and excitement as we enter 26 are continued pipeline growth, positive deal trends, and the progress we're making with our vertical strategy. The pipeline creation trajectory in Q1 is on track to exceed $4 billion, And as we expand our available capacity and add sales coverage, we expect it to continue to increase. In terms of deal trends, they're all moving in the right direction. Deal terms are getting longer and average deal sizes are increasing. In Q4, we saw nearly twice as many transactions completed for over 12 months in duration over what we succeeded with in Q3, while average selling prices increased by more than 50%. As an example, we are sold out of hoppers, and those that are coming up for renewal, often off of short reserve agreements, are getting renewed at 12 months or longer, while we're actually seeing pricing nudging up. Lastly, we're focusing on customers with premium workloads and use cases, which is resulting in superior terms, including increasing those who are willing to prepay for securing future capacity.
Great, thanks, Mark. We have another question from the portal. There are headlines of data center equipment shortages in the market. How is Nebius handling the situation, ensuring access to these products? And do you expect it to have any impact on your deployment? I think, Andre, this would be for you.
Yeah, thanks, Neil. On data center delays. Well, generally building the data centers is a quite complex task, and no one can get away from all of the risks. But I think we are in a quite good shape of managing this risk. As you saw today, we are well ahead of our contracted power, and we are developing 9 contracted sites we announced today. And the main idea and the main strategy is to have the portfolio of sites, so we are not dependent on any specific single data center project to achieve our guidances and deliver our plan. And it's pretty important to understand our differentiation. We're full stack cloud, allowing us to enjoy the flexibility that it provides, that we are not dependent on any size. We can move the loads in between. We can provide it from a different locations. We just operating to ensure that we have enough capacity. And the second one is we already contracted the majority of our long lead items around our own sites to be sure that to ensure the capacity deployment beyond 2026 as well. And the second part of the shortages is the memory and storage. The first important point is our largest deals with Microsoft and Meta. We were able to secure the necessary components last year for the full scope of those contracts. And we secured it in second half of 2025 before any price increase. And for the remaining, we are confident in our supply chain to get the parts we needed to continue to deliver the capacity.
Right. Andre, maybe sticking with you, a few of our analysts are asking, with the announced 9 new sites for data centers that are going to be a mix of owned and co-locations. How do you evaluate when you want to buy versus lease? And how do you expect this mix to shift longer term?
I think we discussed it quite a few times. So generally, we are focused on bringing most of our largest projects as self-developed projects. There are 3 main reasons. First, we get much better total cost of ownership with this. We have much more control over the execution of the project because we have expertise and experience of building our own sites. We also can achieve greater efficiency at scale because generally we tailor the design specifically for what we need and for our technical requirements. But this takes time, and we use leases and partnerships to fill the gaps before we are at a full speed with our own one. So just to sum up, the preference is to develop the infrastructure ourselves, but again, we still need the partners and leases occasionally to support the growth.
Great. Thank you, Andre. Next question from Josh Barrett, Morgan Stanley. It's really around the software stack. What are the most common software tools that your broader customer base, startups and large enterprises, are using and paying for from your AI cloud? And what proportion of your customers utilize your software and services in addition to your compute capacity? And then any color on just how much ARR comes from the software stack today. Mark, why don't you take this?
Certainly. Thanks, Josh, for the question. As I think you know, our AI cloud is purpose-built for AI and is battle tested with our AI customer base. At this stage, 100% of our AI cloud customers are utilizing our AI cloud software, obviously. So we have 100% attach rate. We're very excited, by the way, about the new products that we've launched, like Token Factory and the Aether releases, which have opened up TAM and give us an opportunity to expand into enterprise. Our new acquisition of Tavily also extends our platform capabilities by providing agentic search for AI developers, creating more routes into accounts. Should also mention that we continue to see demand for embedded storage from customers across key verticals, including physical AI, media and entertainment, and healthcare and life sciences. As a result, we are creating solutions that are vertically specific to meet the demands of these customers. We're really in the early stages of our monetization journey, but our software and services make our platform sticky, which enables us to charge more on a relative per GPU hour. We are exploring other monetization models, including consumption-based, such as per token pricing with Token Factory. So, Josh, stay tuned for more on monetization in the future.
Great. Thanks, Mark. Another question from Alex Duvall from Goldman Sachs. It's really on the 40% EBITDA margin target that we gave. What gives us confidence in that? Dado, can you take this one?
Sure. Thanks for the question, Alex. Let me bring the bigger picture. Nebius is scaling, and as we do, so will our margins. Now, let's come to adjusted EBITDA margin guidance. In Q4, the group achieved adjusted EBITDA margin of 7%. And for 2026, we are expecting to reach 40%. We see a tremendous demand for our AI cloud business, and we are investing appropriately to serve this demand. As we reported, the margin of the core AI cloud business is actually significantly higher than the group. And as we scale the AI business, most of our revenue and margin will continue to be driven by the core AI business. So we expect, of course, the other businesses to still operate at EBITDA loss in 2026, but their contribution to EBITDA will be smaller and smaller. So the guidance of 40% adjusted EBITDA margin reflects the current expansion state of the business.
Great. Thank you, Dado. We have a few of our analysts, including James Kisner from Water Tower Research, asking about Tavily. What is the strategic rationale behind Tavily? How is this complementary to your existing offering? And really, is there a lot of demand for this product from your cloud customers? Roma, why don't you take this?
Yeah, thank you for the question. I was afraid we will not come to it. It's quite exciting event for us, and we're super excited to announce our first M&A deal with the acquisition of Tavily, and welcome Tavily team and Tavily customers in Nebius family. Tavily is an agentic search company that they connect AI agents to the web, and it's very much fits in our strategy to become and to be the platform where all the AI developers from startups and enterprises building their AI applications and agents. Tavily got quite a significant progress. They already serve many Fortune 500 customers, and they've got great adoption in developer community and loved by developers. We will continue to evaluate for potential acquisitions of the companies that can deepen customer engagement, stickiness, and increase our lifetime value and strengthen our positions as a full stack AI cloud provider. And this game is such large that we obviously will not build everything ourselves. We will be in the strategic opportunities and will be in the strategic partnerships moving forward, looking for the companies and partners that got a great product, great developer experience, and similar to ours DNA, to build a platform that will be loved by AI developers long term.
Great. Thank you, Roma. We have another question just on capital allocation and M&A, in terms of like build versus buy. Like Neho Chokshi is asking this from Northland. Arkady, when you're thinking about capital allocation, especially whether it's investing in capacity or doing M&A, how do you think about this?
Again, what we're building here, we're building one of the largest platforms for AI developers to build their applications. The largest platform means two dimensions: the scale and functionality, product. And we could allocate capital between these two dimensions. We need to build scale. That's why we need to build all these data centers and buy all those hundreds of thousands of GPUs. And we need to build the product, and we build this product both organically, internally by our own developers, but we will never cover everything. So we go into acquisitions, and we spend some capital to acquisitions as well to enhance our product, to get more talent, and ultimately to develop more and faster. And Tavily is a perfect example of such an acquisition. Hopefully not the last one.
Great. Thank you, Arkady. And I think we're at the top of the hour. So thank you, everyone, for joining our fourth quarter 2025 earnings call. And next quarter, Gili will be leading the earnings process. Thank you, everyone.
All right. So that was the earnings call. There were a few things on here that were pretty noticeable. Well, as far as the call, that was, I don't know how the market's going to take it. I mean, it's kind of expected to have $16 to $20 billion of CapEx, especially for, data center build out, 3 gigawatts of contracted capacity and so on. But it does seem like the stock kind of moved down after that happened. How it's going to act like for the rest of the day, we will see. I mean, it really depends on how the market digests the news. Right now, it's down about 3.62% here. And hold on, let me just share this screen. Yeah, it's down 3.5% pre-market. I mean, it was pretty volatile during the earnings call. Like it was coming up. First, it dropped after the earnings release, and then it came up, and then it dropped. So, I don't know. It really. I guess we have more clarity now that the earnings call is over. I mean, nothing new is really announced. What I can take from it was that the market did not like the announcement of the $16 to $20 billion of CapEx. Maybe it wasn't expecting that. I mean, I don't know why it wasn't expecting that. But clearly, pre-market, the market is favoring a lot of the semiconductor stocks. These are the positions in my portfolio. This is not arranged by weight. It's just in random order. But it looks like LEU or Central Energy is up 2%. Simo, Silicon Motion, added this portfolio when it was around $130, $129. So this is up considerably pre-market. Mercado Libre is up 3.5% pre-market. They just got an upgrade from JP Morgan. I was actually about to post about it right here. Let me share this screen. Yeah, so you guys already know I've been bullish Mercado Libre for quite some time here. So it's up 3.5% pre-market. JP Morgan released an upgrade, set it to overweight, and raised the price target to 2,800. That would actually put about a 30% upside from here. I think, yeah, 30% upside, 30 to 40% upside from here. I don't think this stock is as undervalued as it used to be. Chart-wise, Mercado Libre is probably, it needs a little bit of work to do, but it is good to see that it's coming up here above the 50-day moving average. The 200-day moving average is actually above where it is today. So, it does need a little bit of work. But anyways, going back to the Nebius chart, I wanted to take a look at some technicals here. All right, so pre-market, we're actually trading around $85, which is like right here. Where does that put us on this chart? I mean, we're above the 200-day moving average, which is still good, but we're gonna need to hold the $77 to still remain bullish on the short term. Below most of the moving averages and exponential moving averages. If I look on the weekly chart, still looking pretty bullish, but we are below the 21 and 9 EMA. And for the monthly chart, I mean, we're still above all the moving averages, which is still good. So long-term wise, the chart is still bullish, but we have to wait and see what's going to happen from earnings today. Yeah. Hey, what's going on, Eva? Eva actually has an EU show very early. Actually, it was like right around when I started this one at 7 a.m. Eastern time. But she does it on Spaces on the Wolf account. So go ahead and check that one out. I'm actually going to post Eva's profile here on Twitter in case you guys want to check out her stuff. She posts a lot of great content, and like I mentioned, she has the Spaces on there. So go ahead and check that out. That's on Monday. That's on Tuesday and Thursday at 7 a.m. Eastern. Put it right here. Yeah. So how is this going to play out today? I don't know. I don't know if the market likes that 16 to $20 billion of CapEx. I mean, I don't know what the market really expected when they came out that news. But yeah, I guess it just hit him by surprise. I mean, there was a lot of good news in the earnings call, a lot of good news on the earnings report. They're going to be funding 60% of that CapEx through cash flows. So like, it's like they're going to have to raise ridiculous amount of debts, and they have a healthy balance sheet. So it didn't sound like they're going to raise $20 billion of funds, right? Like, I think that's what the market's thinking right now, and that's why it's dumping the stock, or maybe not that much, but they're not going to do that. They're going to get a lot of revenue in the next couple of years, but it's not going to come fast enough to be able to fund the entire 16 to $20 billion of CapEx. Now, mind you, there is going to be more CapEx in 2027. It is CapEx intensive business, but they're already going to have like 1 gigawatts of capacity, which they said deployed by the end of 2026 was going to bring in a material amount of revenue for the core business. And they're going to be at a run rate of $7 to $9 billion. So it will be funded, guys. I don't think it's like too much to worry about. It is a high CapEx business. I mean, Amazon is raising CapEx to $200 billion for the entire year. This is obviously an inflection point in terms of infrastructure build out for AI. And it seems like the market is pricing in a digestive period where where CapEx is going to be higher than cash flows, and it might stay that way probably for another year. So you need to have a little bit of patience with this in terms of the stock movement. And if you're waiting to buy, you know, I would actually say to be a little bit patient with buying aggressively. Opportunistically, probably not a good time to buy. I don't think the stock is going to $145 anytime soon. I think management just needs to continue executing as they had promised for a long time. And we just need to be patient as an investor. Opportunistically, probably not a good place to make a trade here. I would wait until like around the $77 range in order to do like a tactical trade per se, but I'm not looking to trade this stock right now. Just going to hold on to it. I did the earnings was just exactly what I expected. Like I didn't come into this earnings call expecting like a crazy contract that they announced. I mean, it'll be great, but I don't think it's really going to change anything. If you look at the entire data center line over here, we could see that pre-market, it's just Nebius that's down. But of course, we have to wait for the market to open. I mean, yesterday, everything was down, so it didn't really matter. So do we see some continuation or not? I don't know. It does not seem like the market took that news positively. On the other hand, the Qs are up 42 basis points pre-market. We're actually sitting here back above the 100-day moving average. We did close below the 100-day moving average. We're back above it, and we're back above the 9 EMA. But we're going to need to stay above this 616 level on the Qs for the next few days in order to regain the positive momentum. But arguably, the alpha is really in semiconductors, right? We almost closed the year an all-time high on the SOX ETF. NVIDIA is at $192 pre-market, and I think the move on NVIDIA is going to be made after the earnings. It looks like everything's coiling up here and it's just been range bound for like the last 6 months, but NVIDIA tends to be range bound for months on end before it makes its move. So that's what you're seeing here at NVIDIA. They report earnings on February 25th, apparently. Wow, that's in a couple weeks. Pretty soon. I feel like earnings season just started, but it looks like it's actually coming to an end. Once NVIDIA reports, just a few SaaS companies, and then that's it. But yeah, the majority of the mega caps did report earnings already. Today, after hours, we actually have Arista Network reporting, another hardware company, more to do with Broadcom and Astera Labs. So we'll see what happens with that one. But yeah, I mean, this data center build out is CapEx intensive, guys. This is not cheap for them to do. You already saw the hyperscalers is excess of $600 billion in terms of CapEx. So you can only expect these hyperscalers that are projecting to grow 500 to 600% ARR in just a matter of a year to have massive CapEx boost. And they did. They said it in the earnings call, and that's exactly, I would say that's probably the reason why the market is kind of selling the stock off pre-market. I'd say wait for the market to open. If you're planning on doing any trades with it, I wouldn't nosedive into the stock right now for a tactical trade. But I do think there'll be some good opportunities to buy the stock a lot cheaper, in my opinion, just seeing the way the market is moving right now. But yeah, for me, no tactical trades for me on this one. IREN did drop into the $30 range last week, and then it's since then recovered. But it hasn't recovered materially to the point where it's going to hit new all-time highs. So I would be a little bit careful buying into this stock, expecting new all-time highs anytime soon, because we're just not there in terms of sentiment with capped. All these data center stocks capped last October and early November, right? So IREN was like $76 over here back in October. Nebius was $140. 142 was the all-time high back in October. High 8 actually did hit a new all-time high recently. But yeah, a lot of these data center stocks like topped out in November, October. So, you know, the market is very dynamic. It changes what it's bullish on in the very short term, and it changes it quickly. So you just have to stay on top of it if you're looking to gain some alpha on it, or you can just buy and hold for a long period of time and not care about the short-term noise. right? Or just DCA in if that's the thing you want to do. Just completely okay. You don't need to swing trade or anything in the medium to long term like I do. You can always just buy good companies, hold them for a long period of time. That works. And I would say if you're looking at if that's what you want to do, if you want to buy and hold for a long period of time, like years or even decades, like you don't need to look at the market every day. You really don't. It would just be a waste of time. It'll just be stressful to you. But if you want to outperform the market by multiples, then you can't really do that without keeping on top of the earnings calls, the fundamentals, the TA, whatever it is, unless like you're a day trader or something. All right, so I think that is about it. And we had I don't think we have much in terms of economic news today. I'm just